Welcome to the deep dive. Today, we're really cutting through all the noise, focusing right in on the absolute bedrock of understanding price action today. We're talking about ICT, Inner Circle Trader, and SMC, Smart Money Concepts.
That's right.
And this deep dive, it's really for you, the learner. Maybe you're trying to get past just the definitions, really understand the core mechanics, of institutional trading.
Yeah, exactly. And our mission really is to unpack probably the single most crucial concept in this whole way of thinking, and that's liquidity.
Right.
So if you're maybe prepping for a deep meeting or trying to build a trading model that works consistently, or maybe you're just baffled why the market seemed to zip exactly the wrong way right after you enter, well, this is where it all starts.
We've drawn from a lot of foundational SMC and ICT material here. The goal is to give you that really high-stakes core idea, but, without making it too overwhelming. So let's kick off with that central warning, the one that you see repeated everywhere in this stuff. If you don't know where the liquidity is.
Then you are the liquidity.
Exactly.
And look, that's not just some catchy phrase, right? It's really a whole paradigm shift. It forces you, the listener, to realize, okay, this market, it's often a zero-sum game. And it's frequently manipulated by the players with, well, much deeper pockets.
So the goal today is to shift your perspective, move you from being like the fuel
Yeah.
for the big institutions' moves to actually understanding their playbook. We need to get clear on what liquidity really represents, those clusters of pending orders, the available money, and critically, the stop losses.
And why the big institutions absolutely rely on hunting it down. It's not optional for them.
Okay, let's dive right into that then. Let's get into the engine room of the market. All right, so the simple definition first. Liquidity is just how easily you can buy or sell something, an asset.
Right. High liquidity, you can trade big without really moving the price much.
Low liquidity,
Yeah.
your big order just slams the price all over the place.
Exactly. But within SMC, within ICT, we're talking about something more specific. We're talking about targeted liquidity.
Ah, okay, so not just overall volume.
No, precisely. We're not just looking at, how many contracts traded. We're talking about the concentrated monetary energy that's just sitting there resting in specific price zones. It's the sum total of all those limit orders, the stop orders, market orders, just waiting to get filled at certain levels.
And without that concentration, nothing moves efficiently.
Pretty much. The big market expansions, those aggressive pushes you see, the dramatic reversals, they all need liquidity as the fuel. It's the driver behind those moves.
So, okay, if a big price level is about to break, it usually breaks because the move itself was fueled by all the stop losses that were sitting just on the other side of that level.
That's a huge part of it, yes. But why can't these big institutions just, hit the market order button all the time? Why do they have to go hunting for this liquidity?
Good question.
Well, it really boils down to two things: size and efficiency.
Sure.
Institutions, we're talking banks, huge hedge funds, right?
Right.
They trade positions that are absolutely massive. So if they just placed a giant market order, it would instantly chew through all the available counter orders right there at that price. And that causes huge flippage.
Slippage meaning they get filled at worse and worse prices as their own order moves the market.
Exactly. Imagine you need to buy, say, $100 million worth of USD. You hit buy market at 1.1000. But maybe there's only, $10 million in sell orders available right there.
Okay.
The rest of your order, it's going to get filled at 1.101, 1.1002, maybe even higher as the price rockets up because of your own buying pressure.
Which means their average entry price is terrible. Their trade starts off instantly in a big hole.
Precisely. So to fill that huge $100 million buy order efficiently, they need to find $100 million worth of sell orders at or very near that 1.1000 level.
They can't just wait for sellers to show up randomly.
No way. They have to actively engineer the price move, push price to areas where they know those counter orders, those sell stops, those pending sell limit orders are likely clustered together.
Ah, okay. So that's why they pursue liquidity. It's purely operational for them. They need it to execute efficiently.
It's a necessity, a core operational requirement.
So this institutional requirement, it basically gives us the map, right? Because if they have to hunt liquidity, they're going to leave predictable footprints.
Exactly. And our sources, they're pretty clear on where these hunting grounds are. And guess what? They're always where the highest density of, retail activity is concentrated.
Okay, where specifically?
The first most obvious place is around those clear, obvious swing highs and swing lows on your chart.
Right.
We call the orders resting just above an obvious swing high buy-side liquidity, or BSL. And the orders resting just below an obvious swing low. That's sell-side liquidity, or SSL.
So step one is just marking those out.
Yeah, look at your, say, 15-minute chart or maybe higher. Find the most clearly defined recent peaks and valleys.
Yeah.
Those are like magnets for liquidity. Powerful zone.
Well, let's get a bit more specific. What makes a swing high, say a high probability BSL target? Is it just any old high?
No, good point. You need to qualify it. It's not just any little wiggle. High probability BSL targets, they're usually levels that have held for a decent amount of time, maybe across multiple sessions or even days.
Okay.
Or another key thing, levels where maybe there was a previous attempt at mitigation, like an order block that got tested but didn't quite hold, or maybe it did hold initially. If a level's been tested but respected.
It means more orders have likely built up just beyond it over time. People gain confidence in it.
Exactly. Liquidity builds up there.
Yeah.
And another crucial factor is how clean the level is. If you see the candle bodies consistently closing below the wick of that high.
Suggesting a clear line in the sand that retail traders are watching and using for stops.
Precisely. It becomes a very clean boundary, very obvious. And therefore, a perfect target for institutions needing buy-side liquidity.
That really shifts the thinking. It's not just price patterns. It's anticipating institutional needs based on retail behavior. And, the sources really emphasize that a lot of the basic retail patterns, the stuff you learn first.
Oh, yeah.
Like trend lines, support resistance, they're actually traps.
They absolutely are from this perspective. Think about a classic trend line, right? Price bounces off at maybe 3-4 times.
Yeah, textbook says look for a buy on the fifth touch.
Right. And every retail trader knows that. So where do their stop losses go? Clustered just below that trend line.
Makes sense.
So for smart money, that trend line, it isn't some sacred structure they need to respect. No, it's a visible, high-density line of sell-side liquidity, SSL, just waiting there to be swept.
Fuel for their move.
Fuel. Same logic applies to those textbook double tops and double bottoms. You see two clean highs at the same level. Retail sees resistance. Smart money sees a pool of BSL above it. Those zones aren't really support or resistance in the traditional sense. They are guaranteed clustered fuel, just ready to be monetized.
So the big takeaway here for anyone listening, wherever the chart looks the clearest, the most obvious for a standard retail entry or where you'd place your stop, that is very likely the precise area the smart money is going to target before they initiate their real intended move.
That's the essence of it. You start thinking like the predator, not the prey.
Okay, so this leads directly into the core philosophy, doesn't it? The idea that the market isn't random noise. It's often deliberately manipulated.
Yeah, manipulated by these large institutions operating against, well, the rest of us, the huge, but ultimately disorganized retail trading crowd.
It's like David versus Goliath, but Goliath usually wins here because he anticipates David's moves. Retail traders, even though there are millions of us, we just don't have the capital depth or the coordination.
Exactly. And the big players? They know how breakout traders think. They know where reversal traders put their stops. They anticipate the collective, predictable behavior of the retail crowd, and they use it. They leverage it.
So the whole philosophy is kind of skeptical of conventional chart reading then.
Deeply skeptical, inherently skeptical. They anticipate the reaction. So, for instance, if you have a major resistance level, that's holding firm. Institutions know retail traders are doing two things. They're stacking sell limit orders just below it, trying to catch the reversal, and they're putting their stop loss orders, which are buy orders, just above it in case it breaks.
Right, standard practice.
But if the institution actually wants to initiate a massive sell order, what do they need? They need buyers. Lots of them.
So they need those buy stops above resistance to get triggered.
Bingo. So they might temporarily push the price above that resistance level, just enough to trigger all those retail buy stops. That provides the necessary counterparty liquidity for their huge sell positions.
And then once they've filled their sells using those triggered buy stops,
They let the price collapse, often aggressively, leaving the breakout traders trapped long at the high.
wow. Okay, this sounds very much like some older market theories. The sources were quite clear that a lot of SMC ICT, well, they're modern takes on much older ideas, right? Like Wyckoff.
Oh, absolutely. The connection to Richard Wyckoff is, it's critical for context. His work, we're talking nearly 100 years ago. It was entirely focused on watching the actions of what he called the composite man, basically the institutional operator. He mapped out these market phases. Accumulation happening at market lows.
Where they're buying quietly.
Right. And distribution at market highs, where they're selling off their positions. And crucially, within these phases, the big players, the composite man, actively manipulates the price structure.
Playing psychological games, basically,
Yeah.
like creating false moves. Wyckoff called it shaking the tree to make the fruit fall, didn't he?
As the classic phrase, yeah. Pushing price just past those key retail levels, specifically to trigger stops. They use that triggered liquidity to build up their own intended positions at much better average prices.
So when SMC talks about liquidity sweeps,
They're essentially describing Wyckoff's specific patterns. His spring pattern that's a quick dip below a support level during accumulation, which then reverses sharply back up. What is that? It's an SSL sweep.
grabbing sell stops before moving higher.
Exactly. And his upthrust, a brief push above a resistance level during distribution, which then collapses back down. That's a BSL sweep. Grabbing buy stops before heading lower. They are fundamentally fake-outs, designed to clear the market of stops and allow the institutions to get their huge orders filled without causing massive slippage.
Understanding this whole sequence seems vital then. If smart money wants to get into a big position, there are these two mandatory steps that have to happen first. Manipulation, then displacement.
Yes, that sequence is key. Let's walk through it. First comes manipulation.
Okay.
Let's say the institution wants to buy. They want to build a massive long position. First, they need sell-side liquidity, the SSL below a recent low.
Right.
So they engineer price down, pushing it below a significant recent low. This does two things. It triggers all the retail stop losses placed there.
Which are sell market orders.
Exactly. And it also induces panic selling from traders seeing the breakdown. All those sell orders flood the market, providing the perfect counterparty liquidity for the institution to quietly absorb, accumulating their huge buy position at a really good discounted price.
So they're basically using the market's own selling pressure, which they might have helped create, to buy cheap. They might even take small initial losses on short positions to drive price down.
They might. They absorb necessary losing positions sometimes, knowing that the liquidity generated allows them to execute their primary, much larger trade far more efficiently. It's a calculated cost.
Okay, so that's manipulation. What happens next?
Once that accumulation, that absorption of sell orders is complete, then we see the second phase, displacement.
The real move.
This is the market showing its true colors, so to speak. You see a very big energetic push through previous market structure in the direction they actually intended to go.
Characterized by?
Big, strong candles, often breaking multiple resistance levels on the way up if they were buying. And critically, this aggressive move often leaves behind those specific technical footprints we'll talk about soon, like fair value gaps.
And the power in recognizing this sequence.
It gives you a very strong trading rule, essentially. If you clearly witness manipulation, say, price sweeps below a key low, but then immediately fails to close below it, maybe it just wicks it.
Yeah.
You should instantly consider shifting your directional bias. You should start looking for a reversal, targeting the liquidity on the opposite side of the market. So if SSL was just swept, you look towards BSL.
Because the manipulation itself provides the context, the fuel, for the powerful displacement move that's likely about to follow.
Precisely. The manipulation is the setup for the real move.
Okay, building on that idea of manipulation, let's talk about a specific tactic institutions use to lure retail traders in. The concept of inducement.
Yes, inducement is it's a core SMC concept. It's like the sophisticated trap.
Engineered liquidity.
That's a good way to put it. It's a price setup that looks incredibly appealing, maybe even textbook perfect, to the average retail trader. It's designed to pull them onto the wrong side of the market, often right before the real longer-term institutional move actually begins.
Can you give a practical example of what that might look like on a chart?
Sure. Let's say the overall market trend is strongly bearish, prices are falling. Then the market prints a nice, clean little pullback high, just a small pause in the downtrend.
Okay, looks like a potential short entry forming.
Exactly. Retail traders see that little high and think, okay, perfect, that's my reference point. I'll place my settlement order just below it. Maybe my stop loss goes just above that high.
Seems logical.
From a retail perspective, yes.
Yeah.
But from an SMC perspective, that clean little high is the inducement. Smart money knows that the majority of traders are going to try and sell off that first obvious clean pullback.
So they anticipate that selling interest.
And they might push price up first, just enough to trigger the stops above that inducement high, grabbing that BSL.
Before then continuing the actual bearish move lower.
Correct. So the key takeaway, the key application for you, the listener, is patience. You absolutely must wait until the liquidity associated with that inducement level has been visibly taken out, swept, before you even think about entering in the original intended direction.
So if you're looking for a bearish continuation, You wait for that little pullback high, the inducement, to get run first. Let the trap spring.
Let the trap spring first.
Hmm.
Don't be the first mouse to the cheese.
Okay, how do we get better at identifying these inducement levels?
Well, typically you look for the high of the first minor pullback after a major break of structure downwards. Or, conversely, the low of the first minor pullback after a major break upwards.
So not the main swing high or low, but a smaller, more recent one.
Often, yes. It's usually the most recent, most obvious, easily accessible level that seems to offer a quick, logical entry. By running or sweeping that level first, the institutions gather the necessary counterorders to fuel the real move towards the next major liquidity target further away.
Got it. Now, let's really nail down this distinction you mentioned earlier. It seems critical for deciding what to do right now. The difference between a liquidity sweep and a liquidity run.
Yes, absolutely crucial. Both involve price hitting a liquidity level, like a swing high or low. But they signal completely opposite intentions for what's likely to happen next.
Okay, break down a liquidity sweep.
A sweep signals a probable reversal. Price reaches the swing point, let's say it's SSL below a low, it spikes down aggressively, taking out the stops.
Yes.
But, and this is key, the candle body fails to close significantly below that critical low.
So it might wick below it, but the body closes back above, or maybe just slightly below.
Exactly. You often see this as a long wick on a higher time frame candle. It's like a quick grab and go. This suggests the institutions use that liquidity spike purely to execute large reversal trades, in this case, big buy orders.
So if you see a sweep of SSL,
The probability is now very high that the market wants to move towards the opposing liquidity, the BSL, above a recent high. The sweep indicates the reversal is likely underway.
okay, so the lack of a strong body closure past the level is the defining feature of a sweep.
That's the key differentiator. Now, compare that to a liquidity run, which is often called continuation.
This is the displacement phase we talked about.
Precisely. In a liquidity run, price moves to the liquidity level, say BSL above a high, with real force, with momentum. It breaks the structure cleanly. And crucially, the candle body closes significantly beyond the level that was just run.
Not just a wick, but a solid close past it.
Yes, that powerful close tells you the move is aggressive, there's sustained order flow behind it, and the market is very likely not reversing here. It's highly probable it will continue straight on to the next major area of liquidity, further in that same direction.
So it clarifies that fundamental rule you mentioned. The market is always moving from one pool of liquidity to the next.
Always. That's its primary function.
And understanding how it takes out the current liquidity pool with a sweep or a run tells you which pool it's likely targeting next.
Exactly. If the last area was just swept cleanly without a strong body close, the next target is probably the opposite extreme. If it was run through aggressively with a strong close, the next target is likely further along in the direction of that run.
Mastering that distinction, body closure versus wick sweep, sounds like maybe the single most important immediate skill in applying this stuff. It dictates your immediate directional bias.
I would absolutely agree. It's fundamental to anticipating the next move.
Okay, so if the market really is this deliberate hunt for liquidity, then these more advanced tools or concepts in SMC ICT, they're basically just ways to see the footprints left behind by the hunters, right?
That's a great analogy. Yeah, they're like high-definition photographs of where the institutions acted. Let's start with order blocks, OBs. These get misunderstood a lot. People think it's just any big candle sometimes.
Right. What's the precise definition?
Okay, so an order block is typically the last opposing candle right before a significant structure-breaking displacement move.
Last opposing candle.
Yeah, so for a big bearish move downwards, the order block is usually the last up-close candle before that massive down move started. For a big bullish move upwards, it's the last down-close candle before the big rally kicked off.
And it has to lead to a structure break, like breaking a previous high or low.
Ideally, yes. A valid order block identifies that critical point where institutions manage to accumulate enough orders to overcome the opposing pressure and really initiate the true trend move.
And context matters hugely here, doesn't it? You can't just trade any random last opposing candle.
Absolutely not. Context is everything. A high probability order block needs a reason for being there. It should ideally be preceded by a clear event like a liquidity sweep happening just before it formed, or it causes a significant market structure break itself, or maybe it leaves behind an imbalance like a fair value gap. It needs context.
Okay, and why do these order blocks often act as strong support or resistance when price returns to them later? What's the mechanism?
This is where the concept of mitigation comes in. This is really the heart of why order blocks work.
Mitigation.
Think back to when an institution initiates that big displacement move. Let's say it's a powerful rally upwards. To accumulate their massive buy position efficiently down low, remember, they might have had to place some initial sell orders to engineer price down or absorb selling pressure.
Right, to get their buys filled cheap.
Exactly.
Yeah.
So those initial sell orders are now sitting on their books, possibly at a loss as the price rallies away. When price eventually returns back down to that order block zone where those sells were initiated.
They aren't necessarily looking to buy more.
Not always.
Hmm.
Often, they're returning to mitigate those earlier necessary losing sell positions. They might close them out at break even or a small loss, basically to balance their overall portfolio books for that campaign.
So the order block represents a kind of financial obligation for them. They need to revisit it to clean up their books.
That's a good way to think about it. It's unfinished business. The return to the OB resolves the imbalance they created internally. That's why price often reacts strongly there.
And if that OB holds, if price bounces off it and continues the original direction?
It validates the institutional intent. It confirms the original move. But if price slices right through that order block on the return,
Then the OB itself failed. It becomes liquidity now.
exactly, it tells you the market's intention has likely shifted, and it's now probably targeting the next liquidity zone beyond that failed OB.
Okay, makes sense. Let's move on to fair value gaps, or FVGs. The sources call these areas of market inefficiency, and they seem linked to that displacement phase, too.
They are directly linked, yes. And FVG is often the visual consequence of that aggressive, one-sided move that happens typically right after liquidity has been swept.
How do you spot one? What's the pattern?
It's a specific three-candle pattern. You look at 3 consecutive candles on your chart.
Sure.
The fair value gap is the space, or the gap, between the low of the first candle's wick and the high of the third candle's wick.
And the middle candle.
The middle candle is usually the big expansive one, the displacement candle that rushed through that price zone, leaving the gap between candle 1's wick and candle 3's wick.
So the wicks of candle 1 and candle 3 don't overlap in that price range.
Correct. And that lack of overlap is key. It signifies that within that specific price range covered by the gap, the trading was extremely one-sided. Either aggressive buyers were totally dominant or aggressive sellers were. There wasn't a balanced two-sided option.
Which is why it's called an inefficiency. The market didn't trade fairly there.
Exactly. The market generally prefers efficiency, that two-sided trade, that back-and-forth auction process. So this FVG creates a kind of void or an imbalance. And the market has this inherent tendency to want to return and rebalance, to make trading more efficient in that area.
So it acts like a magnet, pulling price back towards it.
That's the magnet effect, yeah. Price is often drawn back to fill, or at least partially fill, the FVG. So we look at these gaps as potential high probability zones where price might react either reversing or pausing once it returns to mitigate that imbalance.
How do you know which FVG is important? After a big move, you might see several of them printed.
Good question. You need to qualify them too. We prioritize FVGs that are created as price breaks through significant market structure levels.
Like breaking a major high or low.
Yes. Sometimes these are specifically called broken structure gaps, or BSG. If an FVG forms, and that same move decisively takes out a previous swing high or low, it strongly confirms that aggressive institutional momentum. It validates that FVG as a higher probability point of interest, or POI.
What about how much of the gap gets filled? Does that matter?
It can, yes. We watch to see if an FVG gets fully filled, mitigated, or only partially filled. Sometimes price only dips into the FVG slightly before continuing. Those gaps that remain largely unfilled often stay as powerful magnets for price later on.
Okay. One more crucial tool before we talk about time. This seems like a vital filter. Premium and discount zones. How does this define the value of a trade?
Yeah, this acts like the risk manager's final check. It's about valuation. Is this a good price to buy or sell from an institutional perspective?
How do you determine these zones?
It's simple, actually. You just use a Fibonacci retracement tool. You anchor it to the most recent relevant price swing. So if you're analyzing a bearish market, you draw it from the swing high down to the swing low. If bullish, from the swing low up to the swing high.
And the key level is the 50%.
Exactly. The 50% midpoint of that swing is called equilibrium. Think of it as fair value.
Okay.
Everything above that 50% level is considered the premium zone. Prices there are relatively expensive or overvalued.
And everything below the 50% level.
That's the discount zone. Prices there are relatively cheap or undervalued.
And the trading rule that comes from this?
It's fundamental institutional logic. Why would a huge fund want to start accumulating a massive long position way up in the premium zone, effectively buying high?
They wouldn't. They know they can likely manipulate price lower to get a better entry.
Precisely. So the rule is you should primarily look for opportunities to sell, go short, only when price pulls back into a valid point of interest, like an order block or an FVG that is located within the premium zone.
And conversely.
You primarily look for opportunities to buy, go long, only when price pulls back into a valid POI that is located within the discount zone.
So even if you spot what looks like a perfect order block setup, but it's sitting way up in the premium zone during what seems like an overall downtrend.
You filter it out, or at least you recognize it's a lower probability, counterintuitive trade from an institutional value perspective. It's not a good deal for them to sell there.
Got it. So this framework really helps prevent chasing price momentum at bad locations. It forces you to wait for price to come back to a level that offers good value for the institutions.
Exactly right. It imposes discipline. If your potential setup isn't in the correct zone premium for selling, discount for buying, you simply wait. That discipline alone is a massive edge.
Okay, so we've covered where the liquidity pools and the manipulation, the sweeps, the tools like OBs and FVGs. Now we need to layer in the crucial element of when.
Yes, time is fundamental. Smart money doesn't just hunt liquidity randomly. They know exactly when liquidity is typically highest. This often lines up with specific market session opens or transitions. And this brings us back to that concept you mentioned earlier, the power of three.
Right, accumulation, manipulation, distribution.
That cycle, that sequence, it doesn't just play out on a daily chart. It applies to weekly cycles too. And really importantly for day traders, it applies within the intraday session cycles as well. This sequence heavily influences the open, high, low, and close, the OLEC, of any given time period.
Okay, let's break down a typical 24-hour cycle, starting with the Asian session. It's usually the quietest, right? Often just ranges sideways. Why is that?
Well, the Asian session, roughly, let's say 7 p.m. to 2 a.m. Eastern Time, that often represents the accumulation phase of the daily cycle.
Liquidity is lower.
Yeah, global liquidity is generally lower then. Major trading desks in London and New York are closed. So the market tends to range, consolidating within a relatively tight boundary.
And this ranging action serves a purpose.
Absolutely. This accumulation phase sets the initial high and low for the day, the boundaries of the Asian range. And these boundaries then become the first major liquidity targets for the sessions that follow, London and New York, which are typically much more volatile.
So institutions might be quietly building initial positions during Asia, setting the trap.
Exactly. They can use that low volatility period to subtly accumulate or distribute positions without showing their hand too much. They're establishing the framework for the manipulation to come.
Which means the liquidity resting just above the Asian session high, BSL, and just below the Asian session low, SSL, is often the prime target as London opens up.
Very often, yes. Which brings us to the key trading sessions, or kill zones, as they're often called in ICT. Let's use New York time, Eastern time, EastEd, as our standard reference, because that's common in the source materials.
Okay. Where do we start the week?
The official weekly open happens on Sunday evening at 6 p.m. Eastern time, which is Monday morning in other parts of the world. How price moves relative to that weekly opening price early in the week, say Monday or Tuesday, can be really significant. Institutions often try to run the previous week's high or low early on to establish their positions for the week ahead.
Interesting. Okay, moving into the intraday sessions, what about London?
The London session focus, or kill zone, generally runs from about 1:30 a.m. to 4:30 a.m. Eastern Time. This period is very often where the manipulation phase of the daily cycle occurs.
This is where they spring the trap set in Asia.
Frequently, yes. London opens, liquidity surges into the market from European centers, and smart money often makes a decisive move to target either the high or the low that was recently established during the Asian range.
So, for example, they might push price aggressively below the Asian low.
Sweeping that SSL, yeah. They use those triggered sell stops to facilitate entering massive long positions at a good price. And that manipulation then sets the stage for the main directional move, the distribution phase, later in the day, perhaps during the New York session.
So you often see those clean liquidity sweeps, those wick reversals we talked about, happening during the London Open.
Very often. It's a prime time for that kind of manipulative price action.
Okay, then comes the big overlap and the U.S. market open. The New York AM kill zone, when's that?
That key window is usually considered 9 a.m. to 10:30 a.m. Eastern Time. And this period is frequently where the distribution phase really kicks into high gear.
The main directional move for the day. often happens then.
Quite often, yes. And here's a really key strategic insight that comes from the sources. Many traders prefer to focus their actual trade entries during this New York AM session.
Why? Because the manipulation might already be done.
Exactly. You have the benefit of hindsight. The market has typically already shown its hand during the London session. It's performed the necessary liquidity sweep or manipulation. So by the time New York opens, you often have a much clearer, confirmed directional bias for the distribution move that's likely to unfold.
So you essentially wait for London to do the dirty work, the manipulation.
That's what's bring the trap, yeah.
You confirm the displacement that follows, and then you look to join the established direction during the New York AM kill zone when volatility is still high.
That's a very common and often effective approach. You're letting the early hunters clear the path, confirm the direction before you commit your capital.
What about the afternoon in New York, the PM session?
That period, say after the lunch hour, maybe post 12:00 p.m. Eastern, it's often less reliable. Liquidity tends to start drying up as the European traders head home. Volatility can become choppy and less predictable.
So while trades can still happen,
The highest probability setups, the ones that align most cleanly with this accumulation, manipulation, distribution cycle, often occur during those morning sessions. London for the manipulation, New York AM for the distribution, especially during that London-New York overlap when liquidity is at its peak.
so understanding the timing of these liquidity hunts isn't just interesting, it allows you to dramatically narrow your focus. Trade only during the periods when institutional activity is likely to be highest and most predictable.
Precisely. It's about focusing your energy and capital when the odds are most stacked in your favor based on these time-based tendencies. Hashtag tag outro.
Wow. Okay. So today we've really tried to build that foundational context, haven't we? How to read price action through this smart money lens.
Yeah, I think we covered the key pillars. First, liquidity is the essential fuel the market needs.
Right. Second, retail orders, especially those stop losses and pending orders near obvious levels, they are the source of that fuel. And third, all those advanced tools we talked about, the order blocks, the fair value gaps, the concept of inducement, they aren't magic. They're just precise footprints left behind during that institutional hunt for liquidity.
So the mission for you, the listener, is really to shift your viewpoint. Stop seeing the chart as just random candles moving up and down. Start seeing it as a deliberate, systematic map of liquidity targets.
And start anticipating where must the smart money likely go next to get their large orders filled efficiently? Where is the next pool of fuel?
Okay, let's wrap up with our final provocative thought then.
Yeah.
Something for you to really chew on as you start trying to apply these ideas.
All right. We've stressed how important it is to have a directional bias based on this analysis. But here's the trap even experienced traders fall into: stubbornness.
Getting married to your idea.
Exactly. Let's say you do your analysis, you identify a key level, maybe a really clean order block, or the confirmed high of the London session. You execute your trade based on it holding. But then price slices right through it. It gets run with clear displacement. Your setup failed. Your reason for the trade is invalidated.
Right. And at that moment, you have to ask yourself, what is the market telling me now? That failed level isn't just a loss. It's new, high-value information. It's signaling that the draw on liquidity has likely shifted. The market isn't interested in reversing here. It's now clearly heading for the next obvious liquidity target in the direction of the break.
So the challenge isn't just analysis, it's adaptability.
It's total flexibility. So here's the question to ponder. Instead of getting emotionally stuck on your initial bias, trying to justify a trade that's clearly gone wrong, how can you cultivate an objective, almost scientific perspective? How can you train yourself to be willing to instantly flip sides, mentally and maybe even with a new trade, the moment a key level is decisively breached?
Looking immediately for an entry in the opposite direction, targeting that next liquidity pool that the market is now clearly aiming for.
Exactly. How can you ensure you always capitalize on the market's current draw on liquidity, regardless of whether your initial prediction was right or wrong? That ability to adapt immediately, informed by constantly asking where is the next liquidity target, and co., could be the key to turning what might have been a losing trade or even a losing day into a profitable outcome. It's about aligning with what the market is doing, not what you thought it would do.